Armstrong, and I'm going to talk to y'all today about how to invest in the stock market. Kind of one of the reasons why it's really important nowadays to invest in the stock market is that your pension fund and your Social Security is no longer enough to be able to save enough for you to be able to retire, be able to cover all the expenses you have to deal with during your retirement. So because of that, you really nowadays have to offset it with kind of saving out of your own personal income. And really the best vehicle to do that is through, obviously, through equities and bonds and other things that are in the stock markets. And there's kind of two things in smart investing. You have to understand the risk of the underlying assets you're investing in and how to diversify your portfolio to really gain a higher expected return. Because your really goal is to get more than everyone else, right? You want a higher return in the market. Your goal is to guarantee that while mitigating your risk. So kind of the two major investment vehicles that I really would expect someone to invest in are kind of exchange-traded funds and mutual funds. Where exchange-traded funds kind of self-explanatory, but they're traded on an exchange, which means they have an underlying asset that they're backed to, and that they kind of will be priced off of that. So, for instance, an S&P 500 exchange-traded fund, it's indexed to the actual S&P 500, as it has underlying assets are parts of all the S&P 500 stocks. So, because of that, the price of the ETF will be the same as the S&P 500. So, kind of compare that with a mutual fund. A mutual fund is you really entrust your money in a money manager, and the idea is the fact that you expect him to have the market knowledge to be able to gain a higher expected return than just a simple index. But the problem is that a mutual fund charges about 1.5% yearly on your portfolio, which means that it has to gain expected return than a mutual fund, than an exchange-traded fund, which is about 0.25%. So over time, you really don't gain any advantage by putting yourself in a mutual fund versus going with an ETF. So even though a lot of people, the common knowledge is to go with the guy who's going to do the fund for you, it kind of makes more sense to go actually invest on your own and put your money in the S&P or the Dow Jones on your own behalf instead of having a money manager do it for you. And kind of the reason why you do these kind of investment vehicles, as I've kind of already briefed on this before, but diversification is kind of the key to gaining a higher expected return. Now the reason why is the fact that when you diversify out your portfolio, you will mitigate your risk, but at the same time trying to not lower your overall return. Which basically means you have less risk of losing money and a higher chance of just having a positive value. So there's two types of risk you got to kind of worry about as an investor. You have your overall market risk, which for instance would be like if it's a recession, like we were just kind of coming out. Where it doesn't really matter what your stock is, your Apple or any company you are, you're going to be having an effect with the fact that the current economy is in a recession. Of course, you'll have government policy play into that too. Any government policy changes are really kind of out of the scope of a single stock, but of kind of the whole market, along with how investors' confidence feel about the overall market. And besides that, you have what's called a stock's beta, or an individual asset's individual risk, as in the risk of just that single stock. Which, this is the whole point, reason why you diversify, is that if you put all your money into, say, one stock, you have a very high chance of losing money because you put all your eggs in one basket, basically. And where by diversifying into hundreds of stocks and assets and bonds and whatever, what have you, you'll be able to get a higher return because you won't be so requiring on one. You can have 10 lose money as long as the other 90 make money for you. And so it's a lot easier way to do that versus just choosing a single stock. So obviously I've kind of talked about the kind of things to invest into. You're kind of understanding as an investor. Now it's kind of getting more into the types of markets and when to buy what, basically, right? So there's four things to keep in mind. You have bear market, bull markets, short and long positions. So a bull market, of course, is an expansionary time period, right? You're having high economic growth. Everything's, it's a real boom. So because of that, you want things that are going to increase in value. Where a bear market's in a contractionary period, there's a lot of fear in the market, kind of investors are getting out of it, prices are going down. And so besides that, you also have your short and long positions. And what I mean by that, a long position is, when you get into a long position, you profit when that asset value goes up, versus a short position is you profit when that asset value goes down. So kind of take this a little further, you really kind of want to use this information across all different asset classes, right? So for commodities, for instance, a good bull market commodity would be like a national Brent oil fund, which is indexed to the Brent crude contract, which the Brent crude contract is kind of the big overall contract that any investor would trade in for crude. So in a high period of economic growth, this contract really benefits from higher prices. Another one would be, for instance, in a recession, you would of course invest in gold. it's intrinsic. It's inflationary proof. It's just a good thing to buy. There's a lot of risk. For equities, like I said, you kind of want to stick with indexes, but a good long visit for equities would be like the S&P 500, the Dow Jones 30, the Russell 2000, which are all three U.S. stock markets, and or for any kind of offshore stuff, the kind of diversify around the world, Hang Seng, which is a stock market out of Hong Kong for Chinese stocks, and the DAX, which is a German stock market or German stock index. It's the top largest 30 German companies. But you kind of want to have not just U.S. Indexes, because you want to have overall world risk. You don't want to be kind of tied to one country, because a country will also have a beta too, as in it has a simple market. So therefore, what affects that market will affect all the stocks in it. That's why you want to have a more wider portfolio. And kind of besides equity, of course, the last thing are bonds, where you have corporate bonds and treasury bonds. Where corporate bonds are bonds that you buy for large companies. Generally you want to stay for like A-rated, A-rated up bonds, as opposed to a treasury bonds, which gets a lower yield. Where like on a corporate bond you get 7 to 8%. On a treasury bond for a 30-year note you get about 3 to 4%. It's a lower return, but the idea is risk-free, right? The U.S. government isn't going to default, versus you still, even if you are investing in McDonald's, you still have the risk that McDonald's does default. So that's why you want to kind of have both in your portfolio too. Kind of what to leave you with. I do have one thing that I would like to give y'all real quick. It is a handout that kind of covers what I just talked about and gives an example portfolio. It's nothing really that I can kind of guarantee, but it's just a way of kind of a starting point to kind of show you an example portfolio. There's no right answer on how to invest, but this is an example that you can kind of work off of as an investor or someone who's trying to get into investment. Now, they kind of cover all the topics I covered before. I've already talked about the importance of investing for your own financial security, why you want to stay with ETFs or mutual funds, and why you want to keep your portfolio well diversified. And now I would like to thank you for your time and open up the floor for questions. RJ.
When do you think the best time is to pull your money out of the stock market?
You really should never pull your money out of the market. One of the things about it is you should pull it out of the stock market, but anytime there's a lot of fear in the market, it's better to just go ahead and move your things into gold and bonds. You never want to pull your money in cash. You always want to have it in things. But yeah, there's a lot of fear then to put it in safer assets for sure.
What's the best time to sell?
The best time to sell would kind of the same thing, to where to get out of that position, you just want to wait till there's a lot of big price movements, and that's the best time to get out.
When's the best time to buy?
The best time to buy would be to kind of wait for it to see better economic data or news, and then kind of get in the market off of that.
What about currencies?
For currencies, it's kind of one of the things about why